How much more is Adobe stock going to go down? That is what investors are starting to wonder after year-to-date being down over 35%, and after recording Q2 earnings and giving somewhat light Q3 guidance, we're seeing a pullback even more. As I'm seeing this stock trade down 4.75% in the after hours, broke several key technical levels. We'll talk about where we think Adobe stock is going in the coming months and weeks ahead. Now, this is all based on these Q2 numbers that we just got out of Adobe. We'll walk you through these. We'll take a look at the revenues, the profits, the cash flows, the balance sheet, get you all caught up, everything that you need to know about Adobe. But we also got Q3 guidance on that revenue and that earnings side. That also came in a little bit light. Now, speaking of the most recent quarter, revenue came in at $4.39 billion. That was 14% year-over-year growth, beat expectations, which were lowered a little bit, I think, before these quarter hit, but it beat expectations by about $40 million. But what I think is having the stock sell off, and this is obviously what we're looking for when we're on the eve of earnings, just 2 or 3 weeks away, we're getting earnings from all the major companies out there. What we're wondering is what their Q3 guidance is going to talk about. And in the case of Adobe, we're seeing that expectations rolled in. Total revenue expected to be $4.43 billion. The street was expecting much closer to $4.5 billion. On that EPS side, $3.33. That's what they're guiding. Wall Street was expecting closer to $3.40. Again, what Wall Street is expecting is usually setting up these companies to beat on that revenue side and hopefully on the earnings side as well. So when companies start to rein in underneath Wall Street expectations, it's showing you that they're really coming underneath expectations, because these expectations, again, are meant for these companies to beat and raise in subsequent quarters, so the stock reacts in an upward fashion. And in this case, you see when the companies start to pull in that revenue guidance, pull in that earnings guidance for just the upcoming quarter, it starts to make investors wonder about the subsequent quarters. And speaking of those subsequent quarters, we talked about the upcoming quarter was expected to come in at $4.5 billion or 14% growth. I told you that Adobe in the upcoming quarter going to come closer to 4.3 billion. So it starts to make you wonder, what about Q4 where they're expected to do 4.73? How about the next quarter where they're expected to do 4.9, and then out to Q2 of next year, $5 billion. They're expected to be kind of a mid-teens grower on that revenue side. They've already pulled in Q3. Investors are starting to wonder how far down the line with these companies, not just Adobe, but every company that we're looking at, how far the line you got to start pulling in these earnings estimates. Now, speaking of the earnings, here the Q2 numbers came in at that $4.386 billion. We talked about how that was 14% year-over-year growth, and it did beat expectations, which again, probably a little bit softball-ish, down at $40 million on that beat. $3.8 million last year. The thing we absolutely adore and love about Adobe is look at these gross margins. They spent just $540 million to generate this $4.3 billion. That gave us a gross profit of $3.8 billion. That was up from the previous year, closer to about $3.4 billion. Now, they have other operating expenses over Adobe, but what they've done a nice job with this company is this company's already scaled up. This is what investors of like Palantir and Snowflake and a lot of these kind of unprofitable tech companies, they're actually hoping they turn into Adobe, because you see here, our total operating expenses, while across the board they went up, including sales and marketing going up by about 20%, which did exceed our revenue growth. But the thing you have to understand with Adobe is their sales cycle is built in up front a little bit. They get a customer to kind of rebill on some software, and down the line you really start to profit, and that's where you get those hefty gross margins over at Adobe. But across the board, we're seeing costs go up. In fact, they went from 1.9, call it about 2 billion last year, up to about 2.3 billion, but we still have solid operating income. So you take this $3.8 billion worth of gross profit, you minus off 2.3 billion, and you get to operating income of $1.5 billion over at Adobe. Last year, you're about $1.4 billion. You pay some taxes and some interest on your debt. You come down here to net income right about $1.5 billion over at Adobe. Really strong results. You'll see it evidence of cash flows as well. When we come over here to the balance sheet, everything looks about where we were at back in December. So this is a December view, 6 months into June. You see cash and cash equivalents down a little bit from 3.9 billion down to this 3.4. We see short-term investments basically flat. So you'd think that this company's probably either paying off debt or buying back the stock. We'll come down here to total debt, and we do see it has gone down a little bit on the long-term side from 4.1 down to 3.6 billion. But whenever you see long-term debt go down, you just want to make sure it hasn't rolled over into current liabilities, and that's actually where we're seeing it. So we see about $500 million worth of debt taking off of the long-term side. It just got transferred up here to the short-term side, meaning it's due very soon. Now, in years past, now this is a broad-based discussion on all your companies that are carrying debt. In years past, when interest rates just kept going lower and lower and lower, companies would be able to just roll this 500 million where they might be paying a 3 or 4% interest. They might be able to roll it over to 2.9 or 2.8% interest. That is no longer going to happen. Companies like this probably going to have to pay this off unless they want to roll it back into a higher interest loan. Now, when it comes to Adobe, they have plenty of cash on this balance sheet. They have plenty of cash flows. They have plenty of visibility into their business, given it's mainly a subscription software business, has very little overhead. This company is fine, but the longer this interest rate environment stays and corporate debt starts to roll over and companies actually have to come out of their pocket to pay this, that is actually going to become a major story on Wall Street as long as interest rates continue to go up. Again, in the case of Adobe, nothing to worry about in the shorter term. Now, 3 months ended here on the cash flow statement. You see last year's your right-hand column, this year's your left-hand column. You pull down a net income number of about $1.1 billion, very similar to last year. You get stock-based compensation added back in along with depreciation, and you come down here to net cash used by the business, or in this case, generated by the business, at $2 billion. That is why you're not concerned about a shorter term, maybe debt payment that they're going to have to pay in cash of about $500 million, because the company generates over $2 billion with a positive cash both last year and this year. Now, they did buy back some of the stock. When we come over here and look at this from a technical perspective, not necessarily the worst thing, quite frankly, the company could have done over the last 3 months. They bought about $1.2 billion worth of shares last year, just $1 billion. Now, from a technical perspective, I've got some things going on here, but we'll start to narrow this down. First of all, I've got an arrow in the after hours. The stock's trading actually down here. The stock closed today at about $365 per share. In the after hours, trading closer to about $347 per share. It is broken kind of a longer term uptrend, which I had in this green line. This longer term uptrend was intact. I was buying these. I bought Walmart's upper trend. I actually bought Adobe on this trend as well. I ended up getting stopped out of this stock for a small profit as it reversed very quickly. I am no longer buying these upper trend lines because these things are getting cut like a hot knife through butter. Now where this is telling me is I've got a volume profile here on the left. Essentially, this is telling you where there's going to be demand for Adobe shares in the shorter term. And we see this stock could U-turn. It could U-turn like the broader markets and move higher. But quite frankly, it'd have to make quite a move. It'd have to get above these cluster of highs here at $438 per share. This stock would have to go up nearly $100 to get it out of what appears to be a very steep downward channel materializing with this stock. We've seen this in Meta. We've seen this in Netflix. We've seen this in Nvidia. Quite frankly, pretty much every stock we're looking at is locked in one of these kind of downward channels. Now, this stock is down towards the bottom end of the range. We'd expect some kind of rally to the top, maybe back up to $390, $400 per share, only to retreat and likely head even lower in the subsequent weeks and months ahead. The volume profile is telling you that you might see some demand for Adobe shares starting to materialize around the $300 per share mark. That's more than a 10% decline where the share price is today. If we see Adobe start to pull down south of $300 per share, that is an area where I would strongly recommend buying this stock. But what you do have to keep in mind is that if Adobe slides another 15 to 20% in its share price, you are going to have a laundry list of other stocks to buy. So just keep that in mind. I wouldn't necessarily go overweight a stock like this when companies with even stronger stronger cash flows and likely a stronger addressable market heading out of this downturn that the economy and stocks like Adobe are in, probably would be where I would overweight my money. In the shorter term, Adobe likely heading even lower as the technicals and the realization of the fact that Q4, Q1, Q2 into next year, all those earnings estimates are still likely too high, and likely on that earnings side as well. Both earnings and revenue estimates are going to need to come in Wall Street over the next 3 to 4 quarters. That is likely going to have an overhang on most stocks and continue to send them lower. In the shorter term, you might have some pretty spectacular bounces. So if you want to trade stocks like this, there's certainly some opportunities there as well. Hopefully, you guys have a wonderful day out there. We'll be back again soon. Good luck with your investments.